Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Once again, happy Friday. Hope you guys are doing fantastic. Well, rates finished the week worse than where they ended up last week, so it's just continuing the trend that we've seen over the last 2 weeks where rates have just lost some ground. And it's not because we saw a whole lot of real positive economic data. And in fact, rates are getting worse even despite the Dow Jones Industrial Average losing over 200 points, and despite a weaker than expected jobs report that we saw last Friday. So we're losing some ground, and we're actually getting pretty close to breaking some technically significant levels to where we could even see some further deterioration, unless there's a turnaround, and see this trend continue over the next couple of weeks. We'll keep you informed and let you know what's going on, but at least the trend right now is not our friend. It's not that rates are getting horrible or anything like that. We're just losing some ground and off some of the best levels of the year. We're back to where we were about June, and the beginning of the year of this year, rates were worse than where they are right now, and come around middle of June, we all of a sudden saw them get a lot better. But now we might be getting back to where we were beginning of the year here for the next couple of months. We did see retail sales come in. That was a little bit stronger than expected. It was up 0.3%. We also saw the producer price index come in, and that was actually also a little bit higher than expected. The headline number was up 0.3%, and the core number was up 0.2%. The year-over-year numbers look, though, again, to where inflation basically is where the Federal Reserve wants it to be. So what is going to happen from here? Well, we don't know always for sure, but it really looks like that I believe, one, we're probably going to see a Federal Reserve hike here in December. Just everything is indicating that. We're seeing, enough inflation, and the Federal Reserve is going to be, as long as, nothing really changes between now and December. But the Federal Reserve has what they need in order to increase credit, and that's what they want to do. And we're probably going to see, I honestly think, rates benefit when that happens unless we see a whole lot more inflation. So right now, though, we are advising our clients to lock. And as I had mentioned, a couple of weeks ago, rates were at a level where we're telling people to take advantage of those positives in the market and protect yourself. Don't get greedy. And we just need to continue on with that trend. Rates are still phenomenal, and they're just not as good as where they were maybe 2-3 weeks ago. And I think that trend is going to continue between now and the end of the year. We're just going to remain in a locking bias because that's probably where that trend is going to be until the Federal Reserve actually makes a move or doesn't make a move. And then it's, we'll see what happens from there. But typically we should see interest rates be improving with the stock market doing well, not doing well, and also with weaker than expected jobs numbers. But it's just not translating that way. And from a technical perspective, rates are probably just going to continue this trend. Thanks for joining me with Java with Jared. If you guys have any questions, please give me a call. I will talk to you soon. Bye-bye.